Good morning, everyone. Welcome
morning,
to
mate.
Tuesday morning, Kay. Morning to the webinar. Thanks for coming, everybody. Bit of a rush morning this morning. Got plenty going on, so I'll try not to keep you too long today. Just a quick rundown of the headlines and any bits and pieces of news that have come out overnight and this morning. It's going to start off with Japan. Bank of Japan's Amamiya, if I get that name right. Pretty much going with the party line from the Bank of Japan, saying they'll support households with the current powerful easing. And a little comment, which I know Kay will be maybe not welcoming, is that he also said that they won't be changing policy or will not link monetary policy with the term of Kuroda, i.e. that they don't expect Kuroda to go out with a bang or anything like that. Him leaving will not be linked with making a big policy move potentially. So sticking to the main line, we had Suzuki out yet again. More comments from him that he's going to work with the Bank of Japan to tackle the problems going on there, and the usual. At the moment, we call it soft jawboning on watching FX and that sort of thing. No change in rhetoric there. Moving to China, Shanghai is adding to the risk move that we're seeing today. They've said there's been no new cases outside of their quarantine zones and no community spread in all 16 districts. Now, it doesn't mean that they're fully opening everything else, but it's moving in the right direction, and the market's taking that on board a bit further today in terms of possible easing, which will then hopefully ease supply chains, and that's adding to the risk picture today. Australia, not really much coming out. A lot of focus now growing about the elections on Saturday. But we had the RBA minutes, and one of the lines in there was saying that a 40 basis point hike was discussed, although they felt that 25 pips was appropriate at the time, but 40 pips was a possibility. That's again helped Aussie dollar this morning in the risk tones. And also they said that further hikes are likely, which is stating the bleeding obvious at the moment, but it's there in black and white again. So adding to the Aussie bounce there as well. Looking at the UK, we had some really strong jobs numbers today. I want to focus on that a little bit. A lot of the press over here and a lot of the market is focusing on the gain of wages of 7%, a big jump in wages they're looking at. However, the UK split their wages by wages including bonuses and wages excluding bonuses, and the excluding bonus number was 4.2%, only a small rise. The reason that's important is because at this time of year, the wages can be affected by bonuses as we cross the financial year ends, that sort of thing. It's when bonuses can have a play into those numbers. But also, these numbers are matched off against last year, so they're year-on-year numbers, 3-month year-on-year numbers. This time last year, we were in the midst of the furlough. So wages back then, or pay in total, was skewed downwards because people are on minimum amounts. So there's a bit of skew in there, seeing these wage gains over last year because of that furlough effect, and that might wash out. So there are a couple of skews in there to look at. But if you also then bring inflation into the picture, and you look at the inflation numbers, if you take that 7% wage number, including bonuses, adjust it for inflation, wages only rose 1.4%. And if you take the ex bonus number, wages actually fell in real terms 1.2%. So that really shows the position that the Bank of England is in, because they've got a strong jobs market, they've seemingly got strong wages. So if they do hike aggressively to combat inflation, they risk opening the gap between wages and inflation, or let's call it the income margin, because they could potentially lower wages through rate hikes, and inflation may not come down as fast in line with what wages move. So it's a very fine line for the Bank of England. But what they want to do is get wage inflation obviously down nearer 2%, their ideal level. And if they've got wages then running at maybe 2 to 4%, then that's a healthy balance. But when you've got wages at 8% and inflation, say, at 10%, that's unhealthy. So it's a balancing act they've got to do, but don't get sucked into the narrative that 7% wages is strong. It's overheating, because there's plenty of skews in there. A quick look at the Brexit situation. In the background, we've been following this Northern Ireland Protocol stuff. The latest really is that the DUP, which is the Northern Ireland main party, has pretty much backed Boris into a corner. They won't go into a power sharing agreement, or the executive as it's called in Stormont, which, for those who don't know, that the executive is where Sinn Féin and the DUP and other parties start to govern in Ireland, Northern Ireland. And so they won't enter into that collective until they actually see legislation from Boris on the Northern Ireland Protocol that makes the changes that they want to see in the protocol. So right now, Boris is making threats to do that, but at the moment it's just threats. But the DUP are saying, well, if you want a proper government in Northern Ireland, then you need to give us the legislation in the Northern Ireland Protocol. So Boris has shifted a little bit more to saying that they're going to be discussing this with the EU. There's ways around it. There's ways to fix it before he has to enact any measures that will effectively rule out parts of the Northern Ireland Protocol. So that's where we are. A bubbling situation. Market-wise, it's not really impacting unless we get some major news from there, i.e. we actually get some news that he's going to knock out parts of this protocol, and then we'll get the reaction from the EU. Over to Europe, fairly quiet on the news stream. Not a lot of data. We've just had Eurozone Q1 GDP out, a small beat, a pit beat on the quarter, 0.3% versus 4.2% on the quarter. On the year, 5.1 versus 5.0% expected, so a little tack higher, but if we're looking backwards at that data. What we have seen is a Reuters poll coming out, and now, as we've been talking about the last few days, expectations for the ECB are rising. 46 of 48 participants in that Reuters poll expect rates to rise in Q3. 26 of those say it's going to be 50 pips total by the end of QE. That basically means 25 pips in July, 25 pips in September. So the market is now coming into line regarding where it thinks the ECB is going to be next month. As we've been saying, it's been pretty well telegraphed by the ECB members. A lot of them coming out saying there's going to be talk in June for action in July. So market pretty set on what it wants to look at there. So let's take a quick look at what's going on. Today's expiries, not a lot really going on. We've got a fairly big one in the Kiwi, 1.31 billion going off today at 63, though obviously we have moved away from that a bit more today. Nothing much else of any decent size going on today there. Let's jump into some prices. Sterling, obviously the main mover here. Bit of a double whammy, or even a triple whammy, depending how you want to look at it. If I get my chart working properly, come on, there we go. Right, so obviously we've had the strong labour market data, and the market getting on board with the Bank of England. Maybe they're going to have to hike a bit faster or a bit harder. Bailey was obviously out in the Treasury Select Committee, pretty much made a real big mess of things, not very convincing, but nothing too damaging for the pound yesterday. He pretty much thrown his hands up in the air and said we basically can't do a lot about most of this inflation. And in one aspect, I make him right. The UK, the Bank of England, has never been able to control, let's call it imported inflation, energy, food, lots of things that have high volatility pricing that we import a lot because the UK is a net importer. So on that basis, he's quite right, the same as every other country. You can't do a lot with monetary policy for higher energy, higher food costs. But what you can do is start to change your policy to control what you can control, which is the domestic side of inflation. And while rate hikes may not have done an awful lot, what a lot of central banks should have done is remove the emergency portions of their policy, once we were well over the virus. That's the part they left too late. They left too much in for too long. But now they're in a situation where they're, trying to catch the horse after it's bolted. Shut the stable door after the horse has bolted. And that's the position they're in. So he was under a lot of pressure. There was a lot of waffling ramble from some of the members yesterday at this meeting. Long and short is that the BOE is coming out of this looking like they're not in control of things, and they're probably going to have to step up now to make it seem like they're in control. That may insinuate, as I say, potentially harder and faster hikes, but that depends how much they give into political pressure as that grows as well. So we'll have to see the fallout from there. Also, I would say that the strong jobs data came out, another boom for the pound. We've also had some takeover talk or action going on with the UAE telecoms firm taking a 3.3 billion stake in Vodafone. Now that news started coming out towards the end of last week, and in fact, one of our guys in the room was noticing last week that it looked like there was a bid around every hour in the pound, the latter part of Friday, on that possible M&A talk. That may be a tailwind that's coming in today as well. So, when you get these big deals, 3.3 billion isn't a small amount. We don't know when the deal will happen, how they're buying it, whether it's whether they're paying cash for this, whether they're going into the market. But what the market tends to do is front runs things like this. So if it hears of a big stock move, a big acquisition or a big purchase in stocks, and they get the numbers, then it front runs a bit. But we have been seeing the pound lifted pretty much every hour so far today, since probably about 7-8 o'clock this morning. Part of that would have been the strong jobs data, but the fact it's carried on so far pretty much every hour, and I'll just pop the hourly chart up there so you can see what I mean. Pretty much on the hour, every hour, we've seen a green candle fairly solid. That can insinuate that perhaps this deal is being pushed through by 1, 2, 3, however many banks. They're given orders, to get in, buy this amount, so for this UAE company, so they can buy this stock. Again, we don't know for sure, but sometimes the evidence lines up and you can make that comparison. So we've seen the pound rising, as we say, a strong move up now. 1 minute, the pound's heading for oblivion. If we look at what it was looking like into the end of last week, now the picture's turned completely around. And what we get a move now is up to some of these broken levels. Now, I don't usually keep old fibs and broken fibs on my chart. So this yellow fib that you can see there, once it's all been broken, I tend to take it off. I'm not one for using old fib levels going backwards the other way. But in this case, I'm just leaving them on there for the moment because they do coincide, or they have become levels on their own. As we can see, 125 was a level on the way down, and here we are banging our head into it at the moment. So that's a big level, as we can see there. Then we've got another above there. We've got a little zone here between sort of 30s, 40s and 70s. Again, just pretty much based on the previous price action that we've seen before, where these support and resistance areas played its part. Had a little bit of a stop into that area on the way down again, and then after we broke it, that's where we found resistance. So this is the next zone up here that I'm looking at. Obviously quite high, 126s. But if you look at the move overall, and if we take the drop that we've had, the 38.2 fib of that isn't up until the 129.50s. So a long way to go. This has been a big move. So until we can't really say that the trend is changing until we get up to some of these higher levels. Even if we take this shorter term fib from January, that's up at 127.64. So even the move this year still got a long way to go before it even looks like really turning around. Just a bit of confluence on the fibs here. If we take that bigger move from May last year, the 50 fib, the 38.2 is at 129.55. If we take the January move, The 50 fib is pretty much bang on the same level. So there's a decent confluence area there. Again, around this zone, it was a support area. So that's going to add into the resistance picture if we get up there, but a long way to go. So for now, for the pound and especially cable, it's moving ahead of the others. It's bouncing more than anything else. That's partly to do with the speed and the velocity with which it fell. So it fell, a great deal in a short space of time. You've got to expect the reverse reaction, the bounces, the pullbacks to be just as strong. And, that's why we're seeing it up, nearly 300 pips, over 300 pips in the space of a couple of days. It's purely the volatility. Now, if we switch to one of the other pairs, the pound, euro sterling is one that I'm trading for the long term. Again, we had this big false break up here of the 38.2 up at 86, a big level I was watching. It's come all the way back down to the 84s, moving through some of the older zones here. 84.20 was a level I've had on there for quite a while. Again, mainly relating to prior price action around this area. So we can see here, if we follow the line, 84.20 has been support, been resistance, been support, been resistance. Same can be said of 84 down to 83, 85, and then further down to 83, sort of 65, 70. Now I've added to my position, my long-term position here. I'm long 83.50, 8300, and now I'm long at 84.05. Just to put that in the drawer. I was thinking about buying it a bit higher as we were dipping down. I had one attempt which failed, but I'm happy to buy into this 84 level, just to add a small bit to my position. Moves my average up a bit, but for the longer term, I still see this pair moving higher, pretty much based on the central bank divergence. So this, in my mind, may be giving me a bit of a better entry to add to my position than we had several days ago. I'm loath to think that the Bank of England can go maybe hard as fast as what the market may start to expect in the short term. But conversely, when you talk about the ECB, far bigger central bank, if they really are going to start moving into a tightening formation, a tightening pattern, it's going to outweigh what the Bank of England does. Although the Bank of England may be ahead in terms of how many hikes and interest rate level, if the ECB are going to catch up fairly quickly, then they're going to overtake that. So this is one of the reasons why I'm long this pair for the long term, just to ride that out and see what the ECB does. If you take a look at some of the other pairs, Aussie dollar, come on mouse. Again, another strong move here. It was looking very grim a few days ago, but here we are back above 70 handle. We've got the risk on picture. Obviously, big effect of China. If things are easing there in China, that's also a tailwind for the Aussie dollar. We've had the RBA, as I said, talking about 40 pip hikes were potentially on the table. And with the general risk move, it's another strong mover higher. The break back above 70 is fairly strong. I've got this again, another former support and resistance area around about 25.30s. We've just nudged up above that. If we get to hold above that, if we can make a hold above that, then I expect this to push on high, and we might get a move back up to the 71s. What I would say though, for a lot of these moves is, one swallow does not a summer make. So although we're getting a strong bounce here, be careful that it is just happening on one day and we can switch like a light switch and back to risk off on any sort of news, and we're heading back lower again. So that's pretty much how we look at some of these moves. You don't want to marry it. If you're riding the train, stay on it as long as possible, move your stops up behind it, try and lock in some profit, but just be prepared that, this is just one day and it's not necessarily the end of the downtrends in a lot of these pairs. Looking further around, oil, now that's continued higher. Again, probably a lot of that's down to the potential of China. opening up and easing. Obviously, we've still got the energy arguments happening in Europe over what's happening with Russian oil, Russian energy supplies. But in the meantime, it's making another break higher. What we have to look for here is, are we going to get a test of the highs around this 116.70 area, or even a test back up to here? These highs were pretty extreme. So from here, I wouldn't be thinking that we'd look to break these highs unless we get another big shock in markets. Of course, you can never rule out what the OPEC mob and all them lot are going to do. But again, we look for a range. You know, we found pretty good support down here. A lot of people were looking at this area in the room and indeed trading off it. We look to see if the range is going to build here, if we're going to see highs into here, or even if we do get a push up here. If we get a push up into the 120s near these highs again, look to see if it holds. If it holds, then that's potential for shorts to see if we're going to sit in a decent range. Dollar yen looking a bit sideways at the moment. It's not really following anything else that's going on. You know, we're sort of stuck in this 129 zone. That's pretty reflective of yields at the moment. There, you know, if you overlay the picture, we've got a similar picture there. You know, if we take a look at the 10 years, as I say, pretty similar. You know, we've got a bit of sideways action. We're not really moving up, not really moving down. Happy to go sideways. So it looks like for the moment, dollar yen is on the bus with yields, just following the yields while it's sort of fairly quiet. Now, obviously, today we've got retail sales, so that could be something that the market is taking a pause for. They're expected in, and I've got the numbers here, at 0.9% expected versus 0.5% prior. And if you take out the autos from that, it's expected to rise 0.4% versus 1.1% prior. Now, the data, like the CPI last week, is going to be very important. I think that there's a real growing importance in data now. I think prices are going to move much bigger on data than they have been for maybe a few months. So I'm expecting if we get a big variation here in retail sales, we're going to see the dollar move. And what I'm looking for is whether we get a big miss. If we get a big miss, I think the dollar is going to get really hurt because it's going to indicate that the Fed, where people expect the Fed is going to be the top. So these 3 rate hikes that they're expecting over the next 3 meetings, 50 pips each, is potentially going to be where they really do draw the line and pause their hike momentum. And if that's the case, if we get bad news today, that's going to indicate potentially the consumer is facing a bit of trouble, which obviously isn't going to improve as rates rise. So I'm looking to keep a short dollar bias. I already scratched the itch yesterday with a euro dollar long down at the 104.30s, purely because I'm feeling a bit more short-term bearish on US dollar at the moment. And with the ECB in play as well, I just had to have something in the pot. So I put a small long in my book, satisfied the FOMO. And that's moving high, but it looks to be just more of a dragged along by everything else, by the risk picture, by the move in the dollar generally, a bit of soft. But as we've been pointing out, it's got to break the levels. If the price is going to move higher significantly, it's got to break the levels. And we've done some of the small steps, but here we are with a big step, 105. If we can't break above that, then you've got to say that the trend remains. The break is pretty solid. But it depends on where we are into the retail sales. You know, here we are, 104.70s. If we get a really bad number, we're gonna fly through 105. The question then becomes, can we hold that move? If it's just a data move, a knee-jerk algo move, you need to look at, are we going to hold 105? If we can hold 105 after that, then we're going to get further upside, and then we're going to be looking into those highs, 105, 70s, 80s, maybe even a move up to the 106 again. So it's all about moving in and out of the boxes. You know, we've potentially got this range box here, 103.40 to 105. Are we going to push back into this box, which was 105, 106 is? You know, again, take that in context of the wider move. And as you can see, you know, even all these are very small steps compared to where we've come from over the last few months. So take it day by day, take these data points with greater importance than you might do normally. I think if we get a strong retail sales number and we see the dollar lifted, I think that is potentially a good fade. I'm looking at dollar yen, potentially if we get another move into the 130s, and if we get anything perhaps up here, might be a bit of a stretch from where we are now, but if we get anything up towards these sort of levels, I'm going to thinking about taking some shorts in there, potentially with a stop above these highs, just to look to see if we are going to see these rate hikes impacting the US economy. Are we going to see the data start turning lower? We got a poor number from the Empire State yesterday, the first manufacturing number of the new month, which can be seen as a bellwether for the manufacturing for the entire month. And that was pretty bad. We saw the prices number drop there, although employment was pretty good. New orders were down. So what you look at in the data, when you're watching the data and the fundamentals, you have to watch them over several months. But when the evidence starts building up slowly that we're seeing some negativity coming into the data, if we see it in manufacturing, if we see it today in consumer, if we see it in the housing data to come the rest of the week, so on and so forth, the market will start to get a little bit nervous over the path of the Fed. So the fundamental picture, as I say, is looking to see, you know, what's going on. If we get a strong consumer number today, that takes the pressure off. It suggests that the US can potentially wear rate hikes a bit further. But if we start getting these numbers all in the different sectors following a downward move or a bit of negativity, and that picks up, then we're going to see some trouble for the dollar. We'll see yields pull back, so on and so forth. So that's my view at the moment. Let's have a look, see if we've got any questions. Kay, I don't know if you got anything you want to add to the conversation?
No, not really. The retail sales will be important, as you say. Market coming back to perhaps a bit more neutral levels, a bit of the ultra dollar longs getting squeezed. I was saying this morning in the room that if there is a dollar correction, if it's a correction, if there is dollar correction to come, perhaps the second half of May might be a decent time before QT really kicks in the month of June in the US, where base case is still that we see a dollar squeeze then once the punch bowl starts to be emptied. But for the rest, no neutral dollar yen. I'm still base long dollar yen that I bought on those dips that we saw last week. I've started to buy a little bit of euro sterling here because if it's M&A related, well, I mean, if the M&A gave an extra boost to the sterling, it might sooner or later fizzle out. 3.3 billion sterling, if that's the amount, is not going to hold the market hostage for days. I think below 84 right now, looking at ECB as well, it might be a decent risk reward to be long a little bit of euro sterling. And for the rest, no. For those who knew about my MEX CNH position, I closed the CNH this morning on Shanghai, on a little bit better outlook over there. The importance of Shanghai is that if it opens, it will alleviate some of the enormous pressures in the East and South China Sea for the ships being stuck over there. Shanghai being closer to the action than Beijing is, so it's pretty important if Shanghai reopens, in my opinion. So for now, I only got the MEX leg left left open, which is well inside the money, locked in the profits. Got an OCO running 1993, 2007. It goes back above 05 or 06. I think Dolomex might have seen an intermediary bottom. That's really it for now, and we are data dependent, really, right?
Yeah, it's taken a big prevalence now. As I said, we've had times where the data hasn't really meant an awful lot. You look at NFP, and sometimes we've had 20, 30 pip moves over the NFP. So it's whether data becomes fashionable or not, depending on the circumstances for central banks and market expectations for rates.
But I think as well that now that we know sort of what the central banks are thinking and what their plan of action is, data will become more important again to fit into those scenarios, right? Yeah,
it's pretty much to see whether they're right or not. That's what the market's looking at when it looks at data now. Is the Fed right? Is their hike path right? Is it going to support the economy, or is it going to take the heat out of the economy? And that's what the data tell us. That's why we get central banks saying, they're on data watch. But sometimes the data becomes more important to the market than at other times. And this is one of those times when it does. I'm going to just switch to Damon, and he's looking at Kiwi CAD. Is that the area you're looking at around about that 80 zone? That's what I've got the low is from a couple of years ago. We were talking about this one yesterday. If it's what's the low there, 80 86s, 80 80s. So we haven't really, I wouldn't call that a test of that low. You can probably look about 80 50 if we take a line just purely on and this is a monthly chart I'm looking on. So we have had a move, under this 80 level, but then afterwards we have held it. This is way back in 2013, so we're talking long term here. Obviously, this low here is a consideration, but we haven't really got there yet. So looking on the longer term basis, if you're going to be looking for longs, then that's the kind of area you want to be looking at. If we come in a little bit closer, we can see how close we did get to that. But it's pretty much walking the same line as other pairs. Aussie dollar, Canadian dollar. It's all these currencies are bouncing on the risk parameters. So it depends where you want to park the bus, if you like. If you want to wait for a move down there, I'll be worried if this sort of area around here, around the 81s, breaks again and we get a hold underneath it. That looks to be more your support area there. Maybe 80 if we get back under there and we get a hold under there, then you're potentially going to see a move down to these lows and down to that 80 handle. So it's just about picking your levels. Conversely, on the upside, you want to get it back above this sort of area, 8180s, 82s, for a push on higher. If we can't do that, it stays in the box. MZ wants to look at USD TOI Turkey. Good luck with that.
Most of us can't even trade it, right?
Yeah, it's untradeable for a lot of people because retail platforms have switched it off due to the volatility, due to the margin requirements. It's shooting up again higher. I'm not sure what's going on there. If there's been any news out, I've not been following Turkey for quite some time, but it seems to be on the mooch higher again. One pair I did want to look at.
There could be a little bit of stress in the Turkish lira because they are making a bit of a nuisance of themselves in the NATO, trying to block or at least not accept Finland and Sweden's access to NATO. So from there, the uncertainty about Erdogan's, I wouldn't call it behavior, but back and forth between Russia, China, and the EU, Turkish lira might be under a little bit of pressure.
Yeah, we haven't had a new central bank governor for a while, so
no,
for the usually get one a month.
Yeah, and then quickly on the VIX, we are in OPEX week, and typically, as some of as Simon in the room especially has been talking about, is that we typically see a little bit of VIX moves ahead of those option expiries. So I'd say more volatile, could be pressured down a little bit into those option expiries in the this week coming.
Yeah, cool. Yeah, so I just want to take a quick look at the dollar yuan. This is another pair I'm feeling a bit bearish about. Obviously, it's easy to say that after it's had a fairly decent drop off the highs, but we were talking last week, particularly on this chat and in the room, on this webinar and in the room, you know, are we going to start to see a bit of a top coming in? We've got a strong fib level up there, which is also been a natural support and resistance area. With the China opening up, potentially opening up, as we've been saying with Shanghai, that may take some of the steam out the expectation of China to ease, but the data is going to probably be a bit poor for at least a couple of months more while they're still in lockdowns as that lag feeds through. But I'm thinking now we've potentially got more of a stronger case to see a top being put in place. I'm going to be looking at shorts if we get back up towards that high, maybe above 80s, towards 84. I did think about a small short last night, decided to hold off to see if we got a move back higher, maybe get myself a better entry, but that wasn't to be. So I'm not going to chase it here at the moment because we are on a level, as we can see there. It's, you know, where we're finding support right in that old fib. But I think maybe if we do get above the 80s, and depending on the reason why, I'm going to be looking at a small short there. Also to note, I'm still keeping short USD Hong Kong dollar. That's not doing an awful lot at the moment, still stuck up against the top of the band there. For those that may not know, the Hong Kong Monetary Authority, HKMA, has a peg in place or a band in place, 7.75 on the downside, 7.85 on the upside. They're very strong in defending it. They came out yesterday. What was it, about another 6 billion, was it, Kay?
Yeah.
They intervened in yesterday. Something like that.
They should. I actually thought months ago when dollar China was like plummeting down that they might change the peg at some stage, but it seems that they are like really defending it, and they have a lot of ammunition to defend the peg. The market won't break them on volumes. It's not like Soros in the 90s on the sterling. It's HKMA, and if they want, they have their mummy PBOC behind the hand to come and give them a helping hand to defend anything they want to defend. So
yeah, so
it's
for now,
a political decision if they change the peg. Let's put it that way.
Yeah, and it is more one of the risks for this is that it's more to do with China as a whole now rather than Hong Kong out on its own. So that's the additional risk. But cost-wise, it's not costing anything to hold a short here. So I might as well have a go. You know, it's a potential lowish trade. I got stop at 7.86, just 100 pips above if something wonky does happen. But in my mind, it's a lowish trade. Doesn't cost me to sit in anything for a while. I've got some TPs in at 7.82 if we do get a sharp move down, maybe, you know, really strong intervention or some other form of action, jaw boning. If we get a move back down, I'll take some profit there. But it's not often you get, and without counting chickens, it's not often you get such a low risk trade with a central bank or monetary authority as a backstop. So I'm happy to sit in this low cost trade. Not a lot going on there. Any other questions we've got?
MZ Silver. I was looking at it this morning. I'm still very, very long term long. For right now, we are hovering between prior lows around the 2140 and the 22 resistance. I would say keep an eye on gold for your silver as well, because they have been moving in tandem again lately. Gold has a pretty interesting resistance zone, 1828 all the way up to 1837. That may coincide with the 22 bucks on silver. If we fail to take it out, I think we're going to be ranging for a while. Gold now support 1820, but below there around the 1800s, and silver 2140.45 and 21 bucks below there. I think we might be a little rangy right now.
Yeah, cool beans. Thanks for that, mate. Right, as I say, I won't keep you too long today because there's plenty going on in the markets. We want to get back to trading and looking at things. Just a couple of things I'll drop in here. If you're not on the ForexAnalytix platform and you want to come and join us on the chat room, you can do so here. I'll show you the link here. You can come to the forexflow.live site/platform. What I've got here is an exclusive 20% discount as well for the lifetime of your subscription. Just use the code FFL20. And also to highlight that we are running also a traders funding program. So if you want to upscale your trading, you can get an account currently up to 500,000. There is plans to hopefully soon open up a $1 million account. This is particularly good for US traders if you want to get around the FIFO rules, being able to cut in and out of positions rather than just getting in one and getting straight out. No changing around there. Lots of benefits for that program. If you want to check it out, you can check that out again, forexflow.live/funding program. You can find it at the top of the toolbar here. Come and have a look if you want to scale up your trading. Aside from that, thank you very much for joining us today. A fairly quick one. When we get quieter markets, then I'll look to touch into other subjects. We can talk about trading psychology and the ins and outs of trading, discussing some of the things you guys want to know about. Apart from which way prices are going. So that's it for today. Thank you very much for joining us, and we shall see you tomorrow.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.